What's up, everyone? It's Scotty with MoneyVest. So today's video is going to be focused on rates, interest rates, expectations, and more importantly, the uninversion of the yield curve. Yes, folks, after months and months and months of the spreads being negative, the yield curve being inverted, we're finally starting to see some uninversion happen in the markets as the longer dated bonds, which is 10, 20, 30 years, now finally starting to yield higher than the shorter duration bonds, and it's happened with some pairs, which I want to go over in this video. And what does that mean for the economy and for some other indicators that we may need to watch very, very closely. Hope you all enjoyed this video, find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Links to our Discord and Patreon is going to be down below. There is a 16% annual discount that's available for a few more days. I've opened up a couple more spots, and in observance of Martin Luther King Day, MLK, there is a huge sale for all of our courses. The actual individual courses are going to be 60% off. We've never had a sale this big. Link's going to be down below. Coupon code MLK, just only 3 words. And this right here is going to be the four course bundle and 70% off for the entire bundle. This is literally huge savings. And of course, individual courses, two to three course bundles, 50 to 60% off. Again, coupon code MLK. So individual courses and bundles all available at huge discounts. Coupon code MLK, just 3 words. And this expires tomorrow. So only tonight, one day is when this is valid for. So going over to this pair, which is the 10-year versus the 2-year. And this is the most watched and most tracked treasury pair in the markets. What does that mean? That simply means if you take into account the 10-year yield, right, whatever that yield is, minus the 2-year yield, right, so 2-year treasuries, once you take into account this equation, what does that mean, right? Is that positive or is that negative? Because if it's positive, it's a normally functioning market, meaning that the 10-year, which is the longer duration bond, 10 years longer than 2 years, right? So 10-year, which is a longer duration bond, is higher than the 2-year, right? So that simply means that 10-year is greater than 2 years. Only then this number will be positive, right? If for any reason the 2-year, which is a shorter duration bond, is yielding more than the 10-year, then in that case, it's going to be negative, right? And that's what we have experienced for the longest time. We have seen this pair, the spread on the 10-year versus the 2-year, negative for such a long time. This right here was the entire time when this spread was negative, meaning the yield curve was inverted. It's now starting to uninvert. So yield curve was inverted because you can see that it was at under 0%. It even went down to as low as negative 1%, meaning the 2-year was yielding 1% more than the 10-year. That's how crazy the yield curve got. And this is one of the very, very strong predictors or indicators for a recession, because every time the yield curve has inverted, as you can see in the past, so every time it's kind of like dipped below that 0% level, a recession has followed. 1989, 2000s, and this right here, 2007, and very briefly in 2020. And this right here in 2022 and 2023, which is exactly why many of the people believe that, okay, there is a recession on the horizon. But it's not so much about the inversion of the yield curve that creates the recession. It is the uninversion. On the way back up is when the recession takes place. As you can see that this right here, uninversion. This right here, uninversion. This right here, uninversion. This right here, uninversion. What does uninversion means? It means that it's kind of coming back to normalization. It's coming back. So 10 years now moving back up to a higher rate compared to the 2-year. And right now we're kind of witnessing a very similar process of uninversion, because you can see the green candles that are coming in. That means this process is now unwinding, and we are seeing it moving back up to that positive territory. Now, if you compare the 30-year with the 2-year, it's already uninverted, right? So we are already starting to see this process unwind, as this is now a positive number. So you can see that this is now 0.03%. It is no longer negative. It was negative, as you can see that it was negative 0.5 to negative 1%. So it was in these really, really low levels over here. So it was really low, but if it's now starting to move back up, and it's actually already positive. Similar to what we have seen in the past. Again, this was inverted, 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 and the uninversion took place over here. 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 And uninversion possibly will start taking place over here moving forward as well. Now, if you compare these charts to how the markets have reacted, that's where things get really, really interesting. So what I have over here is the 10-year versus the 2-year. The first chart that I showed you guys, this is, of course, the inversion, right? So the red line will always represent the 0% level. So again, inversion, inversion, inversion. And take a look what happens when the un-inversion starts. This right here is when the process of unwinding begins, when the yield curve starts to now un-invert, and it's now starting to move back up to that positive territory. Look what happens to the market every time that un-inversion takes place. Correlate this time period with where the markets are headed. Very, very significant downside. This right here is when the un-inversion is taking place. Look at the markets, right? Pretty significant sell-off. This right here, when the un-inversion is taking place, the market's pretty significant sell-off. And now what you'll notice is maybe the market front ran the spreads as it was already starting to uninvert here. We did see a pretty significant sell-off in 2022. So this right here was the entire bear market of 2022. This right here was the entire recovery of 2023. So many people do believe that as this uninversion takes place, uninversion will lead to a potential recession beginning, and that can lead the markets back lower to possibly coming back down, similar to what we have witnessed before. Now, the one really important indicator to understand this is in the past, there was underlying serious issues with the economy. There was a significant dot-com bubble, which with respect to valuations got way too high too fast. There was a serious financial crisis with respect to the housing bubble. There was a serious pandemic related to the health and safety of people all over the world. Right now, there doesn't seem to be anything that's kind of lingering on, unless it blindsides us, unless there's something that's brewing underneath that may kind of surprise everybody. There isn't anything that's kind of like on the radar that is really troublesome. Maybe the US national debt, maybe the deficits, maybe the inflation being a little bit higher, persistently higher than what the Federal Reserve wants. Maybe there's a possibility for stagflation. There are some issues, but nothing that kind of creates this dynamic where there is some serious underlying issues that could create a very significant sell-off. So that's why, of course, this only happens when the economy starts entering into a proper economic recession where there is declines with respect to GDP. Now, once again, if you take a look at the initial claims, so this right here is unemployment benefits. And every time you've seen that uninversion take place, so this right here, when this indicator started to move back higher, look what's happened with the initial claims. It's also moved up. This right here, boom. This right here, boom. This right here, boom. This right here, pretty significant boom. So just because we're starting to see that uninversion once again, many people believe that, okay, this indicator is going to start moving back up, and that's going to be one of the first things to watch for a recession. Markets will most likely pull back and see that correction and drop if there is a possibility for a recession, because earnings contract in a recession. If there's a recession, earnings contract, and lower earnings means lower valuations for the markets or not that appeal for the markets, and that's when the market starts to pull back. And of course, recession only happens if unemployment's high, and unemployment's only high if more and more people are filing for unemployment benefits. So it kind of brings us back to this indicator. It kind of correlates really well. And just because, again, like I said, just because it's happened in the past doesn't mean it's going to happen again. Many people believe that this time is indeed different, but those are also very dangerous words. That's exactly why I want you guys to be prepared for all potential scenarios. Even if there is a recession, we're ready. Even if the markets do end up pulling back, we're ready. If the markets continue to push higher, we see a strong rally, we're ready. If the market sees rate cuts, we're ready. If the Federal Reserve doesn't cut rates, we're ready, right? The bottom line is we need to prepare ourselves for all outcomes, right? For all potential scenarios, regardless of what happens. Not make a prediction of what's going to happen, but be ready for what may happen, and regardless of what does happen. So that's really, really important. And just wanted to kind of identify this because every time we've seen that uninversion takes place, unemployment benefits have increased, which obviously have created an increase in unemployment rate. So unemployment rate going up, unemployment rate going up, unemployment rate going up, unemployment rate going up every time you've seen the uninversion of the yield curves, because that has, of course, created a recession that followed. So again, the idea here is to really understand the uninversion that's about to take place that we're witnessing right now with the 10-year once again moving up against the 2-year. Is that going to create that dynamic where unemployment starts going up? Is that going to create a recession? That's the real question, because there's been a big time lag with respect to how high the rates have been for such a long time. And it's going to start putting in pressure, more and more pressure on the economy. As we know, credit card debts have continued to go up. A lot of the purchases and the spending has been financed by debt, which of course is causing a significant sort of kind of kicking the can down the road, right? Eventually, if rates stay higher for longer, it is going to start showing up in a lot of the indicators. But the hopes are that inflation comes down faster than unemployment starts going up. And if that happens, of course, the Federal Reserve is going to be more than happy to cut rates because they've achieved their target. So that's the battle that they have on their hands. This right here is the GDP. So you'll notice that the actual U.S. cons, I'm trying to remember what this was. Oh yeah, this was construction employment. So construction workers. And you'll notice that every time we've seen that un-inversion, we've seen the construction activity slow down and really start to pull back. Once again, you can see construction workers, not really being hired and construction slowing down every time we've seen that un-inversion. This right here, again, un-inversion, construction. Construction kind of powers the economy as well, right? If people are not building, if people are not creating, they're not making, if construction is not happening, then that is a big sign that, okay, the economy is slowing down. So if this un-inversion takes place, once again, if we start to see this indicator start moving back up, there is possibility that we see construction starting to slow down, which is going to create that pullback in the economy, some contraction in the economy, which could lead to potentially a recession as well. So these are some things to really focus on because we are seeing that un-inversion takes place. The 30-year versus the 2 years already moved back into positive territory. And God, the market's pricing in 7 rate cuts now. It is absolutely insane how confident the market seems to be with respect to how many cuts the Federal Reserve is going to do. I mean, we're expecting from 5.25% all the way down to 3.5 to 3.75%. So that's about 7 rate cuts is what the market's pricing in 2024, starting all the way in March and ending with the last cut in December of 2024. So that's really where we are with these market expectations. So significant cuts expected in 2024, which I believe is really just opening the door for some disappointment. If the Federal Reserve meets this expectation, that's great. If there's any slight repricing that happens, let's say the Federal Reserve does 4 or 3 or 5, then the market's going to be pretty disappointed in what the Federal Reserve ended up doing with respect to where the expectations were. And that's exactly the repricing risk that we've talked about. But keep a close eye on these indicators. We're starting to see the bond market finally move back higher from months and months of un-inversion, of inversion back to un-inversion, the spreads being negative back to positive territory. But just because it's happened in the past doesn't mean it's going to happen again. The bottom line is that we need to be ready for if there is a recession, if there's any signs of weakness in the economy, unemployment, any of those indicators, then of course we need to be ready for what may happen and may take place moving forward. So I'm cash ready. So I'm sitting about 26% cash. I'm still dollar cost averaging in broad-based ETFs. I'm still selling options and hedging for potential downside. And if there's any type of pullbacks and corrections and stocks trading down below my intrinsic values or lower, I will be aggressive and I will start dollar cost average back into the market and start deploying some of that cash once again. I'm still also waiting for volatility to give me that signal so it does spike 20, 30, 40 levels where I will be ready to once again buy stocks and dollar cost average. As always, make sure that you drop a like if you want to get all those alerts and find out exactly what the strategy is and what I'm focusing on, what I'm watching, and what I'm buying. Links can be down below if you're interested in joining us. There is a 16% annual discount. And don't forget, for MLK, for 1 day only, we've got 70% off on the full 4-course bundle and 60% off on individual courses. Coupon code MLK with the link down below. As always, happy investing, and I'll see you all in the next video.